Welcome to this Iron Financial Explainer. I am your lead analyst, and sitting across the desk from me, as always, is our resident market skeptic. Today, our mission is to help you forge a stronger, much more resilient portfolio by taking the absolute most highly anticipated earnings print of the decade and throwing it right into the blast furnace. We are, of course, talking about Nvidia's Q1 Fiscal 2027 results. Look, the market noise out there right now is completely deafening. The expectations leading into this release were literally heavier than steel, but we are here to cut right through that hype. You have to ask yourself a very critical question today. Is this stock an unparalleled opportunity to build a generational fortress of wealth? Or is it a carefully disguised trap, just waiting to snap shut on your hard-earned capital? Are you holding an impenetrable fortress? Or are you holding a house of cards? Grab your hard hats and strap in, because we are doing the heavy lifting today to find out exactly what is holding this massive corporate structure up and exactly where the hidden cracks in the foundation might be. Let's start things off by dropping the massive Q1 top-line bomb, because honestly, these numbers are almost difficult for the human brain to process. Nvidia just reported $81.6 billion in revenue. That's for a single quarter. Just let that sink in for a second. That is larger than the entire annual GDP of several small nations, and they generated all of it in just 90 days. That represents an 85% year-over-year growth rate and a massive 20% sequential jump from the previous quarter. They didn't just casually beat Wall Street's heavily scrutinized $78.8 billion consensus. They took an absolute sledgehammer to it. We are looking at a mega-cap trillion-dollar company growing at a pace usually reserved for tiny, scrappy Silicon Valley startups.
Okay. I hear the enthusiasm, and the numbers are huge, but I am going to interrupt you right there. Because if this foundation is so incredibly ironclad, and if this revenue beat was really so earth-shattering, why did the stock actually slip 1.5% in after-hours trading immediately following the release? That is the exact question our audience is asking right now. If the numbers are so picture-perfect, where is the structural weakness that the broader market is suddenly pricing in?
Well, to answer that, we really have to begin the drill down into the specific operating segments. Let's look at the absolute bedrock of this entire operation. Data center revenue came in at a staggering $75.2 billion. That is up 92% from a year ago. Now, we aren't just talking about a few big tech companies experimenting with early-stage artificial intelligence anymore. The Blackwell architecture is the new standard. It's not just a chip, it is literally the entire central nervous system of the modern internet. And it has been adopted and deployed by every single major hyperscaler, every single cloud provider, and every major model builder on the planet. When Microsoft, Meta, and Google all collectively agree that your hardware is non-negotiable for their survival, you have established the definitive bedrock of the industry. And with the next-generation Vera-Rubin architecture on track for the second half of this year, they are actively laying the steel rebar for the next massive growth phase before the current one even finishes. And here's the thing, it is not just about the data centers anymore. You really need to notice the deliberate structural change in how they are formally reporting their financials this quarter. They have entirely consolidated gaming, automotive, and professional visualization into a brand new segment they are calling Edge Computing. This new consolidated segment alone pulled in $6.4 billion, which is up 29% year over year. This proves the company's solid foundation extends way beyond just AI server racks sitting in temperature-controlled warehouses. We're talking about the rollout of physical AI, industrial robotics, autonomous driving networks, and massive enterprise workstations. While Wall Street obsesses over the server side of the business, Nvidia is quietly pouring thousands of tons of concrete across multiple other massive, multi-billion-dollar industries simultaneously. Which brings us to the ultimate metric of unyielding pricing power. They posted a rock-solid 74.9% GAAP gross margin. Maintaining margins practically at 75% while scaling physical production this massively is nothing short of an industrial miracle. Think about it. Traditional hardware companies usually bleed out fighting for pennies, constantly slashing their prices just to maintain their market share. Nvidia, on the other hand, is commanding luxury brand margins on heavy industrial equipment. It tells us they aren't aggressively discounting just to move volume. In fact, H100 rental prices actually increased 20% year to date, and A100 cloud pricing is up nearly 15%. When you can charge a massive premium and your enterprise customers are still lining up around the block begging for allocation, your foundation is forged in pure titanium. And here is the absolute ultimate flex of pure financial muscle. Management aggressively pivoted to capital returns this quarter in a way nobody anticipated. They announced a 25 times increase to their quarterly dividend, taking it from a single penny all the way up to 25 cents per share. Think about the signal this sends to the market. A 2,400% dividend hike is a massive anomaly. Pure growth companies and heavy infrastructure building phases usually hoard every single dollar of cash to fund research and development. Nvidia is distributing this cash because their free cash flow is an absolute geyser. They are generating an unfathomable $48.6 billion in free cash flow. They are generating so much cash, they literally cannot spend it fast enough on internal R&D. This is a deliberate, neon-flashing signal of massive structural confidence. And they hammered home that fiercely bullish case even further. The board of directors just approved a fresh $80 billion share buyback authorization, and that is on top of the existing $38.5 billion they already had chambered. If you do the math, that is nearly $120 billion in pure buying power waiting to be deployed. In Q1 alone, they returned a record $20 billion to shareholders. They are essentially telling the open market, you think the stock is priced for absolute perfection and ready for a pullback? Well, we think it's undervalued, and we are stepping in as the ultimate buyer of last resort. They are putting a massive reinforced steel floor directly under the stock price.
All right. Let me take the mic here for a second. You have laid out the top-line hype beautifully, and I will concede the cash flow argument is undeniably strong. But it is my job on this desk to grab a flashlight and look for the cracks in the armor. And as an investor trying to protect your capital, if you only look at the shiny top-line revenue numbers, you are completely blind to the structural rot, and you are going to get crushed when the cycle inevitably turns. It is time to shift the narrative away from the pristine revenue numbers and heavily interrogate the structural risks hidden deep within the balance sheet. Are we looking at confident stocking for a booming future, or are we staring at a slow-burning fuse attached to a powder keg? Let's rip up the floorboards and drill right into the dirt.
Look right here at the raw inventory data. It spiked a massive 20% sequentially to $25.8 billion. At the exact same time, their accounts payable, meaning the money they owe to their suppliers, rose 34% to $13.1 billion. Let's break down the mechanics of why this is so dangerous. They are piling up massive mountains of physical chips while simultaneously pushing off payments to the vendors they buy materials from. Now, management claims this is just confident pre-stocking to ensure they can meet the coming wave of Blackwell demand. But extending payment terms while hoarding inventory is a massive structural vulnerability. Wall Street estimates that hyperscaler capital expenditures, the CapEx budgets from companies like Meta and Google, will hit $725 billion for 2026. But what if that CapEx spending wavers by just 10%? If end-user demand cools even slightly, that $25.8 billion in physical inventory instantly turns into a severe impairment risk. A multi-billion-dollar write-down would crack this foundation overnight. And then there is the terrifying butterfly effect hidden deep within their corporate investments. Nvidia's equity portfolio has ballooned to an eye-watering $73.6 billion. More than $43 billion of that is tied up in non-marketable securities. That means private companies that are incredibly hard to accurately value or sell quickly. But here is the real kicker, and you absolutely have to understand this mechanic. This quarter, $15.9 billion in unrealized paper gains artificially inflated their GAAP net income. Here's how this illusion works in practice. Nvidia invests capital into an unproven AI startup. That startup gets a sky-high valuation in a private funding round, and Nvidia records that jump on their books as cold, hard profit, even though they haven't sold a single share. Their headline earnings are now deeply structurally dependent on broader AI market sentiment. If the broader ecosystem valuations dip, those paper gains vanish in an instant, completely pulling the rug out from under that flawless net income narrative. Next, let's talk about a critical, glaringly absent pillar in this global structure: China. The data center compute revenue originating from China this quarter was exactly zero, a complete goose egg. Despite the U.S. government approving some limited exports for the downgraded H200 chips, the harsh reality on the ledger is that not a single dollar of China revenue has been formally recognized. This is structurally terrifying. This isn't just a missed sales target, it is a massive geographic pillar forcibly removed by heavy-handed geopolitical regulation. You absolutely cannot build a bulletproof long-term global infrastructure thesis when one of the world's largest technological markets is structurally locked out of your core compute revenue stream. And let's definitely not ignore the aggressive internal burn rate. Operating expenses saw a 12% sequential jump, landing at $7.6 billion for the quarter. For Q2, management is expecting that number to hit $8.5 billion, with full-year operating expense growth expected to land in the upper 40% range. Yes, the bullish argument is that they are aggressively spending to build an impenetrable software and hardware moat. But think about the basic math of margin compression here. If overall revenue growth decelerates from 85% down to, say, a normal 30%, but your internal operating expenses are still ballooning at over 40%, what happens to that flawless 75% gross margin? You get a rapidly shrinking profit window.
I hear your skepticism, and I honestly appreciate the forensic accounting, but I am snatching the narrative back right now because you are completely missing the immense, undeniable strength of the forward look. You are digging around in the dirt for hypothetical cracks while completely ignoring the absolute skyscraper being built right in front of your face. Just look at the Q2 guidance. They are officially projecting $91 billion in revenue for the very next quarter. That number totally obliterated Wall Street's consensus, which was sitting at a highly optimistic $86.8 billion. This isn't a company bracing for a macroeconomic slowdown, and they certainly aren't worried about a capex waiver. This is a management team throwing even more coal into a heavy industrial locomotive that is already breaking the sound barrier. It is extremely rare to guide this far above a consensus that is already demanding absolute perfection. And let me meticulously break down why those geopolitical constraints you just warned us about actually make this forward guidance structurally stronger. This $91 billion target is unshakable precisely because it is achieved with exactly zero assumed compute revenue from China. Think about what that really means for the global demand pool. If they can hit $91 billion without their second largest historical market, it means the rest of the world is ravenously absorbing every single chip that rolls off the assembly line. They're building a skyscraper of revenue without even leaning on that massive geographic pillar. And they expect to seamlessly maintain that 74.9% GAAP gross margin while doing it. It proves the moat is unbreakable and the demand pool is infinitely deep. It's a highly impressive guide. I will readily grant you that. But it perfectly highlights the exact psychological problem the market is wrestling with right now, the growth treadmill. The broader consensus estimates aggressively demand that Nvidia sustains roughly 70% year-over-year average quarterly growth just to justify its current valuation. We are officially in an environment that is priced for absolute perfection. Simply beating consensus is no longer a positive catalyst for this stock. It is the bare minimum entry threshold required just to keep the floor from caving in. When absolute perfection is the baseline expectation, those sky-high expectations themselves become the biggest structural vulnerability in your portfolio. How much real, tangible upside is truly left when the market is already pricing in flawless execution for the next 36 months? And that brings us to the final critical verdict for our Iron Financial audience. We have to synthesize these incredibly powerful yet violently conflicting forces. On one hand, you have a corporate fortress generating $48.6 billion in free cash flow, hiking dividends by an unheard of 25 times, and guiding to an unfathomable $91 billion quarter while totally locked out of China.
On the other hand, you have deep structural risks you absolutely cannot ignore. $25.8 billion in potential inventory write-downs, a deeply embedded reliance on paper gains from an unproven AI startup ecosystem, and a valuation treadmill that will absolutely brutally punish even the most minor operational misstep.
So is it an opportunity or a trap? If you currently hold the stock, the sheer cash flow generation and those massive buybacks prove this isn't a fragile house of cards. It is an iron fortress with a steel floor. But if you are deploying fresh capital today, you need to realize you're paying top dollar for a building where the market demands every single new floor be built flawlessly, perfectly on budget, and entirely ahead of schedule. So ask yourself, are you buying the ultimate industrial revolution of our time, or are you buying the top of the most expensive growth treadmill in history? Forge your portfolio wisely, rely entirely on the raw data, and never, ever ignore the cracks in the foundation. Thanks for joining us on this explainer, and we will see you on the next one.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.